This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 4 videos on swing trading and scalping. I want to begin by distinguishing swing trading from scalping. Swing trading, a trader is holding for a big reward. Usually the probability is not high. Scalping, on the other hand, a trader is looking for a very high probability of making a small profit. A scalper is focusing on probability, and he gets his high probability by accepting worse risk reward. A swing trader is focusing on reward, which means good risk reward, and that always comes with low probability. There has to be a reason for an institution to take the other side of your trade. Next, I want to talk about the ideal environments for swing traders and for scalpers. Remember, they're trying to accomplish 2 different things. I think swing traders have a different personality from scalpers. Although scalpers sometimes swing part of their trade and swing traders sometimes scalp, in general, I think it's 2 different mindsets. I think the vast majority of profitable traders are swing traders. It takes a very special and unusual personality to be a successful scalper. Most traders should not be scalping. We have a good bull breakout, 4 consecutive bull bars, 3 good-sized bars closing on their highs. This is a reasonable buy for both a scalper and for a swing trader. If they buy, they could put a stop right below the low of this bar. It's a second entry buy, leg 1, pullback leg 2. The first leg has a reasonable buy here and here as well. But this is a second attempt at trend resumption up, and it's around a 50% pullback. The initial risk is to below the bottom of the signal bar, and the traders buy just above the high of the signal bar. So they get in here, their initial risk is here. It's a fairly high probability trade, and therefore traders have a positive trader's equation if they exit with a reward simply equal to their risk. A scalper buying here, stop here, can then get out here, a reward equal to his risk, and have a positive trader's equation. Some scalpers might hold hoping for more, and some of those scalpers will then get out on a reversal down below the low of this bar, and they'll get out right here. They're concerned, maybe we've got a double top, lower high, and a swing down. A scalper wants high probability of a profit, and that means a quick profit, and they do not want pullbacks, or they only want brief pullbacks. In return, they're willing to accept small reward. Any trader who wants a high probability trade is going to be taking a small profit. That is the trade-off. There always has to be a reason for an institution to take the other side of the trade. If you get high probability, you get small reward and generally relatively big risk. In other words, a bad risk-reward ratio. In general, a scalper needs a probability of 60 to 90% that the market is going to reach his reward before it hits his stop. Also in general, the reward is about the same size as the risk. In other words, a risk-reward ratio of 1, which is not very good. Most traders need to be going for a reward that is at least twice as big as their risk if they're going to be consistently profitable. The scalper gets out here. The swing trader holds on to his trade until the premise is no longer valid. For example, until there's a reasonable reason for bears to take a short. Possible final flag, the biggest bull bar, 20 or more bars into the trend, probably a climactic end to the trend, a bear bar closing on its low. This is a reasonable location to exit longs, thinking that either the market is going to enter a bear trend or it's going to go sideways and evolve into a trading range. The premise of a bull trend is now much lower, so it's reasonable for a swing trader to get out here. If he does, his reward is many times bigger than his initial risk. A scalper will often trade a minor reversal if he thinks the reversal will be far enough down for him to make a profit. It has to be at least the minimum scalp size, and if he thinks the probability is high enough to offset the risk. Remember, a minor reversal means that the trend is likely to continue or at least evolve into a trading range and not become an opposite trend. A minor reversal is small, and a scalper only needs a small profit. The scalper will often trade against a trend if he thinks the minor reversal will be at least big enough for a minimum scalp. For example, here we have a series of buy climaxes here, here, and then 2 bars here, and then here. And this is a very big bar, breaking above the top of the bull channel. The scalper will often sell below the low of that bear bar. It's a decent bear bar closing near its low, looking for at least a test of the bottom of the most recent buy climax bar. He'll take that short as long as the distance between his entry price and that bottom of the buy climax bar is at least as big as a minimum scalp, and if he thinks the probability is high enough to offset the risk. Bulls and bears expect a couple legs down after a parabolic buy climax. It's also up to around a measure move up from this low to this high. We have a bull breakout here. However, they also expect the bull trend to resume after the pullback, either to here or to here, and therefore the reversal is minor. The bear who takes that short typically would put his stop above the bear bar. The top of the bull trend is only a little bit higher. He could put his stop above the top of the bull trend as well. He's looking for the market to test the bottom of the final buy climax bar, the biggest bar in the trend, the breakout above the bull channel. He'll take his profit there. A swing trader will often hold on to his position despite minor reversals, because a minor reversal by definition means that the trend has not changed. The trend is likely to resume. For example, here we have a bull bar, another bull bar, and then we have a pair of bull bars breaking above a trading range, and we have a bull follow-through bar. A lot of bulls will buy that close, expecting that even if we reverse down here, there'll be at least a second leg up. If he buys here and it pulls back, he can buy more here. It'll test back up here. He can get out break even on his first entry and with a profit on his second entry. We have a pullback. It started after one more bar. A bull breakout of a bull channel and a decent reversal bar. It's probably going to pull back for a couple legs. One, pullback, two. Tight channel. It could be the first of a more complex pullback. One, pullback, two. In any case, any bull buying here believes this is a minor reversal and that either the reversal down will lead to a trading range, which it did for about 30 or 40 bars, or a resumption of the bull trend, and therefore he's willing to buy, not exit on the minor reversal, and simply rely on his stop. Again, a minor reversal means that it'll be a pullback, in other words, a bull flag, or at worst, a trading range. In either case, he can avoid a loss by scaling in. Even if he had bought this high close right here, he could rely on his stop and then buy more either above this bull bar or above this bull bar. And then when it gets back up to his original entry price, had he bought the high close, he could get out break even on his first entry and with a profit on his lower entry. Here, late in the session, we have another reversal. However, the bulls are losing momentum. We're getting a lot of doji bars. A horizontal trading range late in a bull trend often becomes the final bull flag. We have the biggest bull bar occurring more than 20 bars into a bull trend. Here, we have the biggest bull bar in about 50 bars. It's probably an exhaustive end to the trend. And it's also a nested wedge. Different ways to count the three pushes. 1, 2, 3. 1, 2, 3. Therefore, this has a pretty good chance of being a major reversal, leading either to a trading range or an opposite trend. It's a good location for the bulls to exit. Minor reversal many bulls will hold long if they buy here. Major reversal, the bulls will exit and bears will start to short. When there's a major reversal, traders expect either a bear trend or a trading range. A minor reversal and a bull trend, traders expect either a bull flag and trend resumption or a pullback and a trading range. Some swing traders will exit when there's a minor reversal if they think the minor reversal might in fact become a major reversal. For example, let's say a bull bought the follow-through bar from this breakout, and then he sees an even bigger bar breaking above the top of a bull channel, and he sees that it's around a measured move up. From this low to the top of what was a bear flag, we broke strongly above, and we went up to about a measured move, and then the market's reversing down. This might become a large trading range, and it could test all the way down to the bottom here. Some swing traders who buy here will exit here, knowing that it's probably going to either be a trading range or a bull flag, but they take that exit if they're willing to buy again when they think the bull trend is resuming up. For example, they might buy above this bull bar, high 1, high 2, or after a bigger test down to around a 50% pullback above a bull bar. This is where the always in bulls buy again. This is not enough to make it always in short, and therefore it's always in long. It's around a 50% pullback. It's testing the breakout point above this bear flag. It's a reasonable place to get long. The bulls who bought again here will exit up here toward the end of the session after a possible major trend reversal. Again, a bull who bought for any reason during this bull trend can rely on his stop, betting that the first reversal down will be minor and there'll be at least a small second leg up. Or he could exit on a reversal that he thinks might be major and then look to buy again on a resumption of the bull trend. I talked about several ways to distinguish whether a trade is a swing trade or a scalp. An important way is how a trader plans to manage the trade when he puts the trade on. If he's planning to manage it like a swing trade, and he holds on through minor reversals, he holds on for 10 bars, 20 bars, 30 bars, even if his profit is less than 2 times his initial risk or his actual risk, it's still a swing trade. If he's managing it like a swing trade, whether or not it's profitable at all, it's still a swing trade. For example, let's say a trader looks at this breakout and concludes it's very strong, and the first reversal down will probably be minor. He goes ahead and he buys the close of this bar. He knows its consecutive buy climaxes here, 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 and here. However, he assumes that any reversal down will be minor and become either a bull flag or a trading range, and therefore he's willing to buy and put a stop below the bottom of the bull trend. There's something special about this particular setup. It's a very strong breakout. Whenever you have a very strong breakout like this, there's a 60% chance that the market will rally for a measured move up from the open of the first bar to the close of the final bar of the breakout. Traders will often put a stop below the bottom of the breakout rather than all the way down below the bottom of the bull trend. This is reasonable. Whenever you use a tighter stop like this, the probability of success is less, but it's still, in this particular case, 60%. A very strong bull breakout, a series of bull bars. The market has a 60% chance of continuing up for a measured move based upon the open of the first bar to the close of the final bar, which would be somewhere up here, even if there is a pretty big pullback in between. If the market goes straight up here in just one bar and he exits, is it a scalp or a swing? Well, the reward is probably many times greater than the size of a minimum scalp, and therefore I would call it a swing. He went for a profit that would have been many times bigger than the actual risk, and I would call that a swing. So for example, if he buys here and it just goes straight up here, his actual risk would have been very tiny, and his reward would have been very big relative to that risk. That would be a swing. Even though he'd be exiting in only one bar, which is what a scalper does, he would be getting a swing trader's profit, and he had the intention to hold for many, many bars with the goal of reaching that measured move target. Look what took place up here. The trader held his trade for about 50 bars. He held through a fairly deep pullback, a 50% pullback, a minor reversal though. And now we have a potential final bull flag right below the target. It's fairly common when the market gets near an important target for the market to turn down before it gets to the target. Because this is a possible major trend reversal, a wedge, 1, 2, 3, or 1, 2, 3, a final flag, and the biggest bull bar more than 20 bars into the trend. In fact, this bull bar is bigger than all the bull bars for maybe 50 or 60 bars. Therefore, very likely to be an exhaustion bar. It's reasonable to get out here. Some swing traders will continue to hold with their stop below the most recent major high or low, with the intention of getting out near their goal. When you're this close to the goal, do you really want to continue to use a stop down here? I think most swing traders would not risk this much to make this little profit. However, it's reasonable to do. Instead, they would exit here, wait for a couple legs down, and then buy again above a bull bar here, looking for a test of this high or the market reaching the target. When the probability is high like this, 60% or more, traders do not need a reward equal to 2 times the risk to make a positive trader's equation. All they need is a reward equal to their risk. The trader who bought here, even though he's exiting with a reward 1 times his initial risk, if he put his stop here, he intended to hold for many bars. He intended to hold through minor reversals. He did here, 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 and he either got out here or he held all the way here. He was planning to manage the trade as a swing trade. He did manage it as a swing trade, and therefore it is a swing trade, even though the market did not reach a reward equal to 2 times his initial risk. His actual risk was below the low of this bar. If he bought here, the market turned down to here and went all the way up there. The most he needed to stay in the trade, in hindsight, was a stop right here. So he actually only risked from his entry price to just below the low of this bar. And this reward, I don't know if it's twice actual risk. Here's his entry price. Here's his actual risk. It's not quite twice his actual risk, but it doesn't matter. Traders would still call this a swing because he held for a lot of bars and he held through several minor reversals. Again, actual risk is just below the low of the deepest pullback after he entered the trade. The bears tried to get a reversal, but it's a higher low, and it's a breakout test of this high. The bears have a bear reversal and a follow-through bar, but bad follow-through here, and now there's a micro-double bottom with another bull bar. This is a reasonable buy for a swing trader, betting that the bear reversal will fail and that the bull trend will resume. However, this is a strong enough reversal down with bear follow-through and a reasonable top, maybe a wedge, 1, 2, 3, maybe a final flag, and then an exhaustive buy climax, trapped bulls who bought above that bull bar. The probability of this trade is much less than the probability here. This has a much higher risk of the bull trend no longer being in effect. The market might now be in a trading range. We might get leg 1, pullback leg 2. It might also be in a bear trend, bear spike, pullback, and channel. The probability here is less than the probability there. You're also buying at the top of a tight trading range, and breakouts tend to fail. So again, the probability is lower buying here. Yet, if you do buy here, you're hoping that the double bottom holds, that the market does not fall below the double bottom. It's reasonable to place a stop below the double bottom. Because it's a lower probability trade, a trader needs to compensate with good risk reward. So a trader buying here with a stop here has to be planning to exit with a reward that is at least twice as big as his risk. He buys above this bear bar or above that bull bar. Let's say he buys above this bear bar. He gets filled right here. His initial stop is here. This is 1 times his risk, and this is 2 times his risk. A reasonable location to take profits, especially since it's near the top of a possible developing trading range. Low probability trade, traders should go for a reward that is at least twice as big as their risk. They need a good risk-reward ratio to offset the low probability. Without that, you are not structuring a profitable trade. In other words, the trader's equation is not positive, and therefore you are not likely to make a profit. I have general guidelines that I use when I define what a swing trade is. For example, in the E-mini, if I'm swing trading, I'm going for a reward that is at least 4 points. If I'm trading in the Forex markets, I'm going for a reward that is at least 40 pips. If I'm trading stocks and it's a $100 stock, my minimum goal for a swing trade is at least 50 cents. When a swing trader takes a trade, he's hoping for a trend. And remember, a trend is a swing that covers at least half the bars on the screen. The minimum goal is 2 legs and 10 bars, but most swing traders are expecting at least 20 bars, and that is about 2 hours on a 5-minute chart. Also, the reward should be at least twice as big as the risk. It often is many times bigger. It's common for traders to take a trade and they're not sure if the profit will be a big scalp or a small swing. Most traders should only be taking trades if they feel like they can take it for a swing trade. These are all reasonable swing entries. We have a 2-bar bull breakout closing on its high after a series of other bull bars. Reasonable to buy here, buy the close, reasonable to buy here, high 1 buy, high 2 buy, reasonable to buy. More complex high 2, high 1, pullback, high 2. All are reasonable swing trades, and it's reasonable to use the same stop, either below the bottom of this buy climax or the bottom of the bull trend. The minimum reward for any one of those entries is based upon the distance to the stop. For example, you could buy here, stop down here, betting on a buy the close bull trend. If you buy here, stop here, 1 times risk is right here. It's reasonable to exit here because you're taking a high probability trade. If you're going for a swing instead, 2 times risk is up here. And you can see there was some profit taking here. This is where scalpers would get out. This is where swing traders would at least take partial profits. A scalp means that you're going for a reward that is less than twice your risk. Most scalpers take profits within 1 to 5 bars, and they prefer that the market not pull back, not reverse. For example, a trader might sell below the low of this bear bar and then scalp out. A trader might buy above this bull inside bar, betting on a little bit more up. A trader might buy this close. A trader might buy here. A trader might buy below that doji bar, betting after 5 bars up, there'll be buyers below. Here we have a bull II and a bull trend, so a trader might buy above that small bull bar, and they might buy this close after a bull breakout bar. You could buy below this bear bar, even though it's 3 pushes up, 1, 2, 3, it's about a 15 bar or 10 bar bull micro channel. The odds are the first reversal down will fail and will become a bull flag. Or you can buy above this inside bar. It's a small high 2, high 1, high 2, or you could also call it a wedge bull flag for trend resumption up. And we have a strong bear breakout and strong bear follow through. Probably you'll get at least a small second leg down. A scalper will sell the high of this bear bar and get filled right here. This looks pretty easy to do, but it's really not. And beginners should not be scalping. And most experienced traders prefer not to scalp because it's hard to do and it doesn't suit their personality. Any scalp is a reasonable swing trade. And all of these are reasonable scalps, and they're also reasonable swing trades. Even selling here is a reasonable swing trade, although it turned into a loser. If you are scalping, it's easier to make money if you can use a swing stop and scale in. For example, if you're scalping, and let's say you bought here, it's better if you're able to use a stop down here or down here and then buy more lower. For example, the size of a scalp lower, or the size of 2 scalps lower, or on a reversal up, as long as this entry is at least as big as a scalp below your first entry. The traders who do buy here and buy more here will often try to get out break even around their first entry, and then with a scalp on their second entry. Therefore, they want that second entry to be at least the size of a scalp below their first. If you are a scalper and you're using a wide stop and you're scaling in lower, it increases your probability of success, but it also increases your risk. You therefore have to be trading a very small position, at least initially, and you have to have the temperament that allows you to have a trade go against you. For example, if you buy here, are you able to hold long when the market is doing this, relying on your stop here or here? If you're not, if it causes too much stress, you cannot be doing that long term. That's not a career type of trade for you, and therefore you should not be taking that trade, at least not for a scalp. A swing trader would be much more comfortable buying here and putting a stop here or here, trusting that the odds are the market's going to have a second leg up. A scalper, on the other hand, is going for a very small profit, and he's very concerned about a risk that becomes greater than his reward. If you're unable to trade that comfortably, if you have too much stress, you cannot be doing that type of trade. And that is one of the main reasons why most traders should not be scalping as their primary source of income. It's just too hard to do emotionally. It's not fun for most traders. Most traders do not like to do it. It's too stressful. When the market's clearly always in long, and it is all the way up here, a swing trader can buy at any time and for any reason. However, he has to use the correct stop. And the correct stop is always below the bottom of the most recent strong leg up. In other words, the most recent higher low. Here we have a higher low, not yet a major higher low, but after you start to get a strong rally, especially a rally to a new high, this becomes a major higher low. No matter where you bought and for whatever reason you bought, once the market is up here, traders will put their stop here. If it was here or here initially, they'll trail it, they'll move it up to here. And the same here. No matter what reason you use to buy, all through here, once you have a strong breakout, traders will see this as a major higher low, and they'll move their stop here. If you're buying anywhere in here, once the market is here, traders are going to tighten their stop to either here, the bottom of the most recent breakout, or the bottom of the most recent leg up. Swing traders are going for a reward that is at least twice as big as their risk, and they allow pullbacks. For example, if you buy here, the market pulls back further, you're still holding on to your position. Even though this is a pretty good bull bar, and the market fell below it, swing traders will still hold long because their stop is probably down here. They allow pullbacks, and they expect to hold on to the trade for at least 10 bars. Most swings last at least 20 bars, and therefore swing traders are willing to hold for a long time through a lot of pullbacks. If you're holding on to a trade that's going to last 20 or 30 bars, you're going to have pullbacks, and some of them are going to be pretty big. For example, like this. After every strong breakout to a new high, traders tighten their stops. The market goes up here, you raise the stop to here. Whether it was here or here, you raise it to here. Now we have a strong breakout here. the stop is now here or here. That's called trailing your stop. Scalpers can only take a trade if they believe the probability is 60% or greater. And they want that probability to be 60% without scaling in. They're willing to scale in, but when they take the trade initially, they believe they're taking a high probability trade, a trade that has a probability of at least 60%. These are reasonable trades. Buying here, 60% chance the market is going to go up for a reward equal to the risk. Buying here, 60% chance it's going to go up at least as big as the risk. And when the probability is high, you can swing or scalp. The probability is high for a scalp, not high for a swing. Buying here, it's a high probability trade for a scalp, not necessarily a high probability for a swing. And that's the same here. You know it's a high probability that it's going up for a scalp. You hope that it's going to go all the way up here. It's only a 40% probability that you're going to get a swing. Any entry is only a 40% probability of a swing trade. But many entries are a 60% probability of a scalp trade. Here's an example on the 5-minute E-mini chart. If your stop is 8 ticks away from your entry price, then your risk is 8 ticks. If the reward is 16 ticks or more, twice the size of the risk, I call that a swing trade. If the profit is less than 16 ticks, I call it a scalp. Here we have a double bottom in a bear trend. Pretty good buying here, and you have a good buy signal bar. So let's say a trader buys here, betting on either a scalp, betting on a trading range or a bear flag, or possibly even a bull trend or reversal. If he buys here, his stop is going to be below the buy signal bar, and in this particular case, it's 10 ticks below his entry price. He entered 1 tick above the high of that bull bar, and his stop is 1 tick below. If he exits here, he has 10 ticks profit, and that's 1 times his risk. That is a scalp. It's a high probability trade. I think this is certainly good enough for a scalp, but it's also a reasonable swing trade. If he exits here, 2 times his risk, I would call it a swing trade. And obviously, if he exited below here or below here, that would also be a swing trade. The minimum goal for a swing trader is at least twice his risk. When he buys here, he has a 60% chance of the market going here, and maybe a 40 or 50% chance of it going here, and probably less than a 40% chance of it going all the way up here. If it does, this is 3 or 4 times his risk. That is a great risk-reward ratio. So, for example, if he exits here, a wedge, 1, 2, 3, testing near the high, you have a bear bar, you have a second leg up, strong enough breakout here for at least a small second leg up, and now it's reversing down. If he exits below this bear bar, he gets filled here. This is 38 ticks profit, which is far more than twice his risk, and therefore buying here and exiting here is a swing trade, just like exiting here is a swing trade as well. This is a 5-minute chart of the British pound versus the dollar. Most Forex traders don't refer to trades as swings or scalps. They call everything a trade. I use the term swings and scalps. Traders who do refer to trades as scalps are trading on 60-minute charts or smaller, and a scalp is between 10 and 50 pips. All other trades are simply trades. I usually distinguish swings and scalps because I tend to think of them differently. We have a pair of bull bars breaking out. We have a potential high in a trading range, or maybe there was a bear trend here, and maybe this is a bear flag. In either case, we're getting a pretty good breakout, a pair of big bull bars. It's reasonable to buy this close. It's a high probability buy for a scalp, and it's a reasonable buy for a swing trade. Swing trade, with a breakout like this, maybe 50% chance you'll get twice your risk, and maybe 40% chance you'll get more than twice your risk. If a trader exits here, he has 40 pips profit. Is it a scalp or is it a swing? If you're exiting here, I'd probably call it a scalp. You're exiting without any pullback, and you're exiting maybe around twice your risk, maybe less than twice your risk. If a trader exits here, he has 80 pips profit, which is clearly far more than twice his risk if his stop was here or here. And he sat through a pullback, another pullback attempt, and he has 2 legs up. Minimum goal for a swing trade is 10 bars and 2 legs. If you buy here, you have 1 leg, pullback, 2 leg, and you have more than 10 bars, and you have more than 50 pips profit. All of those things are enough for me to call that a swing trade. Scalpers and swing traders are trying to do different things. Scalpers want high probability, and swing traders want big reward. That means they're looking for certain setups that are different from one another. Swing traders want big trends. Scalpers want pullbacks. On the left, I have a bull trend. It's a 5-minute chart of the E-mini. On the right, I have a daily chart of the euro versus the dollar, and it's a strong bear trend. There are a lot of similarities between the two, and that's because they are the same type of trend, a bull version and a bear version. Lots of dojis, lots of overlap. The pullbacks are small. It's a small pullback bear trend. And the same here. It never looks like it's going to go a long way. We have lots of overlap here. We have lots of sideways here. The bars overlap a lot. There's a lack of consecutive big bull bars, a lack of consecutive big bear bars. Therefore, the trend looks like it'll be a bull leg in a trading range, yet it goes for many, many bars. This looks like a bear leg in what is trying to become a trading range, yet it goes a long, long way. Because it looks like a leg in a developing trading range, the probability of it going far is small. However, you can see the reward is huge. Therefore, huge risk reward, great risk reward, but low probability. It always looks like it's going to reverse or enter a trading range, yet it continues to trend. Charts look like this for perhaps 10% of the bars on any screen, and the same with here. Small pullback trends, about 10% of the time you'll see them, and they're great for swing traders. Scalpers, some scalpers absolutely hate them. I don't mind them. I don't make as much money in a small pullback trend if I'm scalping than I do if I'm swing trading, but I don't hate anything. I like everything. I think everything is interesting. Swing traders in general are looking for stop entries, and they're looking to hold for a long time. If a swing trader bought for any reason, like above this bull flag after this breakout, he holds until there's a reason to exit or until the end of the session. If you're trading the daily chart of the euro versus the dollar, you enter for any reason, maybe below this bear reversal bar after this bull breakout, and you hold indefinitely until there's a reason to exit. Here we have a micro double bottom, fairly climactic move. Maybe you want to exit down here. The bull buys above the bull flag. The market stays always in long. Maybe he'll exit below this bear bar at the end of the session. Maybe he'll exit at the close of the day. Either way, he makes a lot of profit. A swing trader on the daily chart, if he did sell here, there is no reason to exit. He can hold for many, many bars, 30, 40, 50 bars, and then we're getting fairly climactic down here, micro double bottom, the biggest bear bar, one of the biggest bear bars in the entire trend, spike, pullback, parabolic channel, reasonable to take profits and look to sell again on a bounce. Bull bar, doji, bull bar, bear bar. Bad follow through. The bar's not all that big. Lots of tails on tops of the bars. Lots of overlap. It always looks like it's going to convert into a trading range. The probability of it continuing is low. Yet it does happen. As I said, about 10% of the time, you'll get a small pullback trend. And the reward is huge. The stop can be far away. If you buy here, you might put a stop here. But if you buy here, or if you're still long here, your stop is now far away. But the huge reward more than offsets the risk. That means there's a good risk-reward ratio. There always has to be something in it for institutions taking the other side. If you get great risk-reward, they get low probability. If you're buying here and you have great risk-reward, you have low probability of making that great reward. Yet it happens about 10% of the time. And that's true here as well. We have a couple bear bars here, not especially big, then dojis, bad follow through after that bear bar. It looks like it's trying to convert into a trading range. However, it continues for a long, long time. Since it looks like it's trying to convert into a trading range, what I'm saying is the probability is that it is going to start to convert into a trading range. That means there's a low probability that it will not. There's a low probability that it will just keep trending down and down and down. Low probability, but huge reward. Great risk-reward ratio. Great for swing traders. Scalpers need high probability. Buying when the market looks like this, the probability is not all that high. Also, if you're buying here, for example, you're looking for a small profit, yet your risk is big. That means the trader's equation, when you're buying for a scalp, a small profit, is bad. The result is there are very few good scalp setups when the market's in a small pullback trend. And therefore, scalper does not make much money. He misses most of the trend. And the same is true here. On a daily chart, traders don't use the term scalper and swing trader. They use the term trader and investor. A trader is someone who's looking for a quick trade, exiting after 1, 2, or 3 bars. An investor is holding until market conditions change. Traders on a daily chart like this are not expecting the market to continue down forever. We lack consecutive big bear bars. We're getting dojis. We're getting overlap. It looks like the market will soon convert into a trading range. Therefore, the probability is low. A trader, a fast money trader, is looking to exit after 1 or 2 bars. He needs high probability because he's looking for a small reward, a scalp, and his risk is relatively big, so he has bad risk reward. The only way he can make money is if he's taking a high probability trade. Trends that look like this do not have high probabilities of making small profits, and therefore there are not a lot of good scalp setups. When a trend is tight like this, you can't buy, and if you're selling, you're always selling at the bottom of a trend that looks weak and it looks like it's about to reverse. Reasonable for a scalper to buy this. They have a breakout and a double bottom bull flag and a good buy signal bar. But if he's a scalper, he's looking to take quick profits. When the market looks like this, constantly looking like it's about to convert into a trading range, there are not many high probability setups for scalps, and therefore a scalper ends up missing most of the trend. He gets one trade here, and that's pretty much it. And the opposite is true here in a small pullback bear trend. Scalper might sell there, but remember, he's looking for a quick profit. So he gets out there, and he has very few other opportunities to make money. Maybe he sells below this bear flag, and then he scalps out. The result is he makes very little money compared to the swing trader. Not a lot of high probability shorts selling at the low of a bear channel that has lots of dojis in it. The result is scalper does not make many trades, and he does not make much money. And a swing trader makes a lot of money. Bull trend, well, bull trend and bear trend, but there's something different from what I just showed. This is a 5-minute chart of the E-mini, and this is a 5-minute chart of the euro versus the dollar. A bull breakout, lots of consecutive big bull bars, probably will convert into a channel. Spike, pullback channel, a spike and channel bull trend. The pullbacks are small, so it's also a small pullback bull trend. But at 3, 4, 5, 6 bull bars, I would not call it a small pullback bull trend. I would call it a strong breakout and a buy the close bull trend. Therefore, the breakout is a buy the close bull trend, and then we have a channel. Here, a series of bull bars, 3 or 4 bull bars, buy the close bull trend. And then after 3 or 4 bear bars, you have a sell the close bear trend. The pullbacks are non-existent or they're small. Therefore, it's also a small pullback bear trend, but I do not use that term when you're getting a series of consecutive trend bars. I prefer to call it a sell the close trend. I'm selling closes. I'm buying closes. The probability is high after you've had 3 or 4 consecutive bull bars with very little overlap. Probability is high that the market's going higher. Therefore, a scalper can buy the close here. If he scalps out, another buy signal. If he scalps out, another buy signal, another buy signal. Lots of buy signals in contrast to what you see in a small pullback bull trend. So a scalper can make a lot of money in a strong breakout. Decent reversals, he can make money on the reversals. First reversal down, bulls are going to buy it after a strong breakout like this. We're probably going up for some kind of a measured move. And therefore, every time the market reverses down, the scalper has another buying opportunity. He ends up making a lot of money. Market's in a small pullback bull trend, and now we're getting a breakout. 2, 3 bull bars. Bulls will start buying closes. If a bull scalps out, he can buy again, he can buy again, he can buy again, he can buy again. Lots of scalps. After a reversal, 3 or 4 bear bars, he'll do the opposite. He'll start to sell closes. If he scalps out, lots of other closes that he can sell. This is a small pullback bull trend, but I would not use that term here. I tend to call this a buy the close bull trend and this a sell the close bear trend. Scalpers like this kind of a market because they can enter every bar, every 2 or 3 bars and make a lot of money. High probability. Unlike a small pullback bull trend, a strong breakout has high probability, and that's what a scalper is trying to find. The high probability offsets the big risk. If you buy here and you're scalping, your reward is small, your risk is big, so bad risk reward, but very high probability of making money. And the same here. If you're buying here, your stop might be down here. Even if you're scalping, you're putting a stop here or here, so your risk reward is bad. Small reward, big risk, terrible risk reward, but high probability of making profits. Scalpers will take that trade all day long. They want high probability. They always have to take bad risk reward. They're always going for a small reward, and that means their risk reward is always bad, but great for scalpers despite the small pullbacks. They can buy repeatedly take profits, converts into a bear trend, a sell the close bear trend, lots of trades for scalpers despite small pullbacks. There are certain environments that are bad for swing traders. When the market is mostly sideways, it's very difficult for swing traders to make big profits. They end up getting a lot of small losses or small wins. Look at this chart. Lots of reversals. Sometimes there are little swings up and down. This is a great environment for scalpers. They'll enter with stops, they'll enter at the market, they'll enter with limit orders. They can scale in to increase their probability. Remember, a scalper is looking for a small profit, and he needs high probability. Sometimes the setup will not look like it's a high probability trade, but if he's willing to scale in, he can increase his probability and turn the trade into a high probability trade. The result is lots of opportunities for scalpers to make money. Lots of small profits add up to a big profit. For example, we have 2 legs down, reversal. A scalper might buy here, and then he's scalping. He's looking for a quick profit. He might exit there. He might buy at this low. He may buy at this low. He may buy a certain number of points or pips down, and then he can buy more lower if it keeps going down, and then he's exiting with a quick profit. And lots of scalps like this, buying above a bull bar after the reversal up, and then scalping out, selling on the reversal down, or selling at this high, and then scalping out, buying on a higher low major trend reversal with a good bull bar. But he's a scalper, so he's going to take profits maybe at that high. And he just keeps doing this all day, selling above that high, willing to scale in higher, scalp out, a two-legged pullback from a bull reversal. He buys, he scalps out, and he just does that all through this chart. Lots of opportunity to make a lot of money. However, all of these reversals are a problem for swing traders. In general, they're entering with stops. When you're getting all of these reversals, the swing trader keeps getting stopped out with small losses or small profits. Big profits are less common. If this were a daily chart, instead of using the term scalping and swing trading, I would call someone taking quick profits a trader, and someone holding for a long time, I would call him an investor. Swing trader might buy the reversal, but then he sees the failed breakout and it's starting to go down. 3 bear bars, he might exit. Small loss here, possibly. If he buys the higher low, we have a double top and a failed breakout. Big bear bar, he might exit again. Small profit. We got a strong breakout, he might buy the bull flag, and then he gets an immediate reversal, small loss. Therefore, lots of reversals with lots of sideways trading is a bad environment for swing trading. I began by distinguishing swing trading from scalping. Swing traders are focusing on reward. They want big profits. In other words, they want a great risk-reward trade, and they pay for it by low probability. Most of the time when they take their trades, they're not going to get their huge risk-reward. Scalpers, on the other hand, focus on probability. They want a high probability. They're going for a small reward. Sometimes the risk is big, the stop is far. Therefore, they're willing to take terrible risk-reward in exchange for a high probability of winning. I then talked about the ideal environments for swing traders and scalpers. Swing traders like trends, any kind of a trend. Scalpers like reversals, pullbacks, and they also like very strong breakouts. For example, a buy the close bull trend or a sell the close bear trend is good for both a swing trader and for a scalper. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on swing trading and scalping.